Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, this is our last episode of 2024. Thank you so much for listening this year. And we end with a topic we've talked about for the last few years, actually, which is Federal Reserve policy. So this week we had what was the Fed's final meeting of the year, and there was an expectation that the Fed would cut rates 1/4 point. They ended up doing so. What makes it sort of interesting is that when we look at inflation and expected inflation going forward, basically it was a little surprising because inflation has firmed up. So it was a little bit surprising that the Fed actually cut rates this week, but they are signaling basically fewer cuts next year. Let's jump into some data. So let's start with inflation. And what I often like to look at is core inflation measures. This excludes the volatile food and energy sector and is sort of viewed as a metric that will help us understand sort of the direction of inflation. Now, remember, the Fed has a 2% target. So when we look at the core consumer price index and we look at the monthly numbers over the last 6 months and annualize those, basically, we're at an annual rate of 2.85%. So almost a percent above the Fed's 2% target. The core producer price index averaged an annualized rate of 3.4% over the last 6 months. So both numbers really well above the Fed's 2% target. So inflation has firmed a little bit compared to other recent months. Now, there's other measures we can use to understand expectations about the future. One being the break-even rate. This basically takes nominal bonds and inflation-protected bonds, both issued by the Treasury. You can back out an expected inflation rate, what's called the break-even, and that sits at 2.58% looking forward for the next year. So market participants also believe inflation will stay above 2%. So it's interesting that the Fed is sort of tolerating this higher inflation level and that they went ahead and cut rates 1/4 point. Now the funds rate range is down to 4.25 to 4.5. It's still a bit restrictive. Officials have commented, for example, Chair Jerome Powell in his post-meeting press conference talked a bit about a looser job market, right? So they're wanting to strike a balance of watching prices, but also watching jobs. That's their dual mandate, and basically making sure that they're balancing the risks of both. Now, another thing that happened at this meeting, doesn't happen in every meeting, is that the Fed issued its latest Summary of Economic Projections, or what they call the SEP. This is interesting. It's kind of a survey of Fed officials, and then they'll publish statistics, sort of medians and highs and lows, things like that. And so, for example, people tend to look at the median almost as a forecast, but it is just a median. Let's look at 3 metrics that were available in the SEP this time around, as they always are. The first is inflation. So the core PCE inflation that the Fed's seeing for 2025 is 2.5%. So they kind of did all this knowing and believing that they're forecasting still an above 2% inflation rate, lower than where it's been, but still above their target. Now, the second thing is GDP growth. They actually increased their rate a little bit. They're seeing a GDP growth rate for 2025 at 2.1%. That's an interesting number because it's equal to the long-term trend. So think if we go back well before the pandemic and we kind of average growth through the pandemic, basically all the way to now, the average rate is about 2.1%. So the Fed's expecting that to continue next year. Anyway, the last is their funds rate projection. So the median is 3.9%. And the important thing for that is it reflects 2 more 1/4 point cuts next year. And that's actually half as much as what we saw in the last Summary of Economic Projections, or SEP. And so think of it as the Fed is signaling, hey, we're going to slow down. And in the post-meeting press conference, if nothing else, Chair Powell basically talked a lot about being data dependent, looking at the environment. They may or may not cut 2, they may cut more, they may cut fewer. But they're going to be data dependent, which includes a look at jobs and a look at prices and inflation. Now, another forward-looking metric that we can draw upon is the Fed funds futures. So once again, a way of sort of inferring what the market participants expect the Fed to do next year. And with all this action, basically the market is now forecasting a single quarter point cut next year. So much less than what was viewed a few months ago. And so the punchline here is everybody's realizing the Fed's going to slow down. And I will say, even again on this last cut, the sense we get is that they really debated it, and there was some chance they weren't actually going to cut it all. But to quote Powell, he said, "Quote: Today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability." End quote. Now, in the wake of all this, market interest rates jumped up a little bit. So the 10-year Treasury yield rose to 4.52%. With forward rates, those are the rates implied in the yield curve for the 10-year rate 10 years from now or 20 years from now, still hovering, around a range of 4 to 5%. So basically the market, once again, is signaling higher rates for much longer. And that means higher costs of debt for all of us, businesses, individuals, and our government. Ultimately, though, another market reaction the day of the Fed meeting, stocks were down a lot. So the S&P 500 actually fell 2.95% for the day, and the NASDAQ fell 3.56%. So even though it's felt kind of like a positive environment, that was one signal to say, hey, look, if the Fed's really going to slow things down, keep things restrictive, keep rates higher, equity markets may not like that. So again, things have settled, but that was an important move to be mindful of. So anyway, to wrap it up, I would just say that what has happened here is the Fed kind of got assertive in cutting rates to start, but they've slowed down that rate cut pace, and in doing so, really are trying to keep things restrictive to allow the job market to cool a little bit more, and in their view, that should put us on a path to see inflation fall towards their 2% target. But they pushed out when we're going to get there a bit, and next year they're expecting 2.5%. So again, this is obviously something that everybody's tuned into, in the sense that we don't want, Fed policy error. We don't want more inflation, but we also don't want a weak job market and the likelihood of a recession that goes with that. So as we move into 2025, we're going to be publishing our outlook first week of the year, and monetary policy and where we see it going. Obviously, all part of the work we do, as is the case with many investors. Anyway, I'll sort of end where I began. Thank you so much for listening today, and in fact, listening this year. We look forward to bringing you more of the Sightlines podcast episodes in 2025. Until then, happy holidays, happy new year, and we'll talk to you in 2025. Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.